Live. I am Travis Nixon, a career data scientist, joined by Tyler Tucci, a former hedge fund PM, now the head of research at Cinerai. This morning, we thank you for joining us while some really big events are going on. You're going to see Tyler's eyes flickering everywhere all over his 27 screens that he has going on in his room. The CPI print is coming out. And so, like live as we're talking. So, this morning is going to be an exciting episode as we're able to learn from Tyler. What is he seeing in that CPI print, that so important number to dictate what's going to go on with the market? Tyler and I were speaking before today's episode, and we were talking about how right now it seems that the current rally that we're experiencing, the stock market kind of on a tear since mid-June. That rally is based on the market pricing in a 75 basis points decrease between now and December of next year. Am I getting that right, Tyler?
75 basis point decrease between March and December of next year. And that is basically the entire market in one trade is will they, won't they be cutting next year?
And CPI print today could affect that view, right?
Did. CPI print was flat month over month, which brings us down to 8.5, just 8.5. That's it. Year over year. Core was 5.9. So that is the first step in the right direction we've seen. This is the first sequentially lower print we've had. We'll be back to you if there's some anything interesting in the components. But yeah, we're down to 8.5 year over year from 9.1. That will definitely give the Fed some breathing room in terms of, do they have to go 75 or 50? This probably lets them go 50 now that we've seen a sequentially lower print. They could talk about potentially trending down. Stocks have thus far reacted quite well to this, obviously. If they're not going to be tightening us into oblivion and the discount rate's not going to be higher, forward equity valuations can do well.
Now, when I'm going to be rewatching this later, I'm not one of our viewers that's necessarily going to understand the full implications of this. So you're looking at your own portfolio and you have some longs, you have some puts. What are you happier about on your portfolio today? What does this mean for your portfolio? And are there pieces that are going to benefit and pieces that are going to suffer out of this?
I mean, this will be good for all the really beaten down growth names. I think today will be a growth day. Let's see, I haven't checked rates, but I would guess tens are rallying, pretty sharply here. So this should be a risk on day. We have all the makings. The dollar is lower, which is helpful for U.S. risk assets. So this will be very interesting. What will be more telling is if we can't close, near the highs of the day or very, very green and sustain this pre-market momentum here. I see tech almost up 2%.
And tech was suffering yesterday. Do you think in preparation for a bad CPI print today?
Yes, I mean that's part of it, right? Where everyone de-risks before the event, and you get reactions like this, where now it's just running away from everybody, and we have a day of pain for shorts, and that's kind of what we will see is this just pain for shorts, or are institutional buyers and larger money starting to nibble here and find actual value on a medium term basis? That will be the thing that gives us follow through or not, I think.
All right. So this is actually a very, very timely episode. Wednesdays, we're turning Wednesdays into our sector view day. So every Wednesday you can tune in and we're going to be coming in and providing a whole view on a certain sector. Today is actually going to be financial services sector, which we are not one of those companies. We are a tech company that gives insights and views on the market. But financial services is going to be an interesting one, especially given the print today. We've got some views on where the market overall is heading. So stay tuned for that. But first, I want to check in on yesterday. We were running some experiments. Yesterday, we've been tinkering with our one-day models, which is something that you get access to when you subscribe to Foliko, our stock market insights product. Now, Foliko was giving us some tickers that looked interesting, and on that basis, I went in to do some one-day trades on Teva and Ford. There was a few other tickers that we checked out, but those were the two that I really went in on. Teva's kind of gone sideways since then. Ford went down. It's rallying here in the pre-market today. Now, remember, these one days, are really it's from the day you receive the data, which is would be today, to close tomorrow. So really, it's tomorrow's close that we're talking about when we say that one day, which means that the trades I made yesterday, I'm going to be taking them out this evening, angling towards today's close. Now, a lot of these were calls. We're going long on this. That's the experimentation that we're going in on. So, given that the market looks like it's going to be having a great day today, I'm pretty excited about it. I think we're pretty well positioned. But tomorrow, I'll give you that full detail. And if that's working out, we're going to go pretty deep into what we're seeing for the next wave of opportunities on the one day. After this, probably end of next week, we're going to move on to experimenting with the 1 week and best practices to use that. And we'll be working through this. There's different periodicity within Foliko, which is so powerful. You get this 1 day, 1 week, 2 week, 3 week, 4 week view. And so setting up collars, setting up time, delimited trades and stuff like that, I think this is going to be great practice for that. So stay tuned for that. But today, Tyler, banks, financial services. What do we thought? What do we think?
So let's give the let's serve dessert first. Will you show your overall view and the statistical analysis we put together? Because we can start there, and then we'll dive into the single names and the nitty gritty.
Sure thing. All right, and let me increase the size here so we can see what we're doing. All right, so I've built some code here that allows us to put in a list of tickers. It weights all the time horizons so that they're equal. When you're making a 12-week prediction, obviously your price movements are going to be much larger than your 1 day. So the first thing that we need to do was statistically make it so that a 12-week movement and a 1 day movement would be equal in size compared to their relative baseline. So in other words, you can directly compare 1 day with 12-week. Okay. The second thing that we're doing here is we're doing some statistical tests to say, if a stock price is estimated to be up 1% and then down 1%, then up 1%, there's not really a statistical view on that. Okay. So we can't with confidence say that we have a view on this stock going up or down. Statistically, it's kind of a wash. So what we do is we also put some confidence intervals around whether or not we feel a certain ticker is going to go up, stay neutral, or go down. So we have all these lists here. These are past lists that we've analyzed. Today, we're going to be looking at regional, or no, not regional, U.S. banks ETF. So XLF, you can see what XLF is made of here. And then our bank picks, we're going to be honing in on Goldman Sachs today. Goldman Sachs has caught our eye a little bit. So we read this in. And again, here's our time horizon. So here's the 1 day all the way to the left. And then you read out all the way out to, we actually have 16 weeks here, although the 16 weeks is an experimentation phase. So you won't see that in Foliko today. That's something that we're trying to bring out to everyone this fall. But it's just not stable enough to say that we're going to have confidence in that metric yet. So what we can see here, our orange line is that list of bank picks, which for now is just Goldman Sachs. Blue line is the market, all 1,100 companies on our coverage list. And green line is our general banks. Now, a couple things to note here. Everything is south of the zero. Everything is negative. So if you were long everything today, our models would say that 12 weeks from now, you're not going to be happy, no matter what you purchase, right? However, it is pointing to some interesting things of a sharp decline in the near term. And then from there, at the 3 to 4 week range, it bottoms out and heals for quite some good returns at that. So Goldman Sachs specifically, we're not seeing really that sharp of a downturn. Goldman Sachs, out of all the picks that we've talked about, better in comparison if you were to go long on them now. But banking, we see this 3 to 4 week sideways or sharp downturn, sideways movement, and then a strong rally. Now, notice that's a pretty similar story across all of our tickers. If we come in and we do something like tech, just XLK. XLK, let's see. Yeah, XLK is showing a very similar picture, short-term weakness with long-term strength. To me, and remember, go back a couple weeks, look at our view for FANG, right? We're kind of the crystal tower of tech. And we said that all our models were pointing to a localized bottoming around September. Well, guess what? 4 weeks later, from today, we're seeing the exact same thing. The data is doubling down. September is that localized bottom followed by a pretty strong rally, which is why we're continuing to see signs of a bottoming on the market, followed by what our models are saying could be a bull market coming this fall and winter. So there's the dessert. If we go into that two sample test, we have here our bank picks and XLF. We see, remember, you want this number to be below 0.5. That means there's only a 5% chance of us being wrong. So Goldman Sachs being better than banks in general, we accept that hypothesis, if you will. So this means that Goldman Sachs is going to be significantly stronger than the rest of the banking ETF. All right, Tyler. And we can also compare this just with the market in general. If we do leave, yep. So if we compare Goldman Sachs with the market in general, the strongest hypothesis by far is that Goldman Sachs beats the market.
Yes. So
all right.
Now into the individuals. So on the left, you will see the spot price of all these stocks, and then the Foliko 1 week, 4 week, and 12-week price forecasts, and then what that works out to be in terms of percentage terms on the right here. Instead of hammering away about how bearish some of these forecasts are, I'm going to talk about the ones that aren't. So I've highlighted those in green. So we've presented to you Goldman as our favorite. Really a flat forward return on Foliko amongst some pretty gnarly forecasts. So that gives us that relative strength is something that gives us a bit more confidence and suggests to us at least that we're looking in the right place. It still doesn't look like things are all clear in Europe. I suspect that would probably play a role in a local bottoming, and not a local, an intermediate bottoming in stocks as that whole thing kind of clears. If the ECB is reducing their balance sheet and hiking rates, who knows what that does to the banking sector there. It's been a long time since it had to function, anywhere near normally. So that'll be, we're not trading those. That's a call down for, another 40% after the beating. But we do we would like to see those start to perk up before we got more confident in the market overall. Regionals, go ahead.
So I wanted to point out something real quick to tie together what, and do you mind zooming in? Tie together what people are seeing on your screen versus what we just looked at statistically. So you're going to see here down, and down, 1 week, 4 week, 12 week on Goldman Sachs, right? But look at how much of that downside for the 12 week is taken care of in those first 4 weeks, which is why statistically we're seeing if you're getting rid of all that downside very, very quickly, what you see generally statistically is after that 4 week sharp downside, you're actually seeing a lot of healthiness coming out of that afterwards. So if you're getting all that downside on that projected piece out of the way in those first 4 weeks, that means that we've got room to repair after that. Right. So I just want to make sure that the narrative that we're talking is speaking with each other.
Yes, and I think it is, because the relative strength in the forward forecast is pretty indicative of clearly which one you want to be long. Regionals, we those are some nasty downside forecasts. Huntington Bank shares, I believe, is a California regional. That forecast kind of makes sense to me. Mortgage rates are significantly higher than they were. Those regional banks do a lot of lending type of business as opposed to some of the things the larger banks can do. So to the extent that demand is dropped and things like that, especially in a higher tax, less tax friendly area, we could definitely see a bleed out in especially banks in that area like that. Not something I really want to trade though, for a lot of reasons, specifically where they are in the charts, the liquidity of the options, and I just have better ideas, right? So, and the other interesting one I did find were and this was kind of shocking to me because I thought I would find the exact opposite. It's the traditional payment processors that are showing relative strength here. It's not Square and PayPal, really. It's Visa and MasterCard. And I thought that was very interesting because there's been some negative news around Visa, and I don't recall, but a well-regarded short seller was out with a report and a bunch of notes on Visa. But that would be very interesting. That would be kind of the U.S. manages to shrug off a recession. We have a softish landing, and these payment stocks don't do so bad. Or the other way, this goes well, at least short term, is it's the end of cycle and everyone's levering up. So the credit card companies will have a good quarter or two left, and then things will turn crummy again. So those are the two ways I think you could get traditional payment processor outperformance. Again, just because the forecasts are neither here nor there, not something I'm really hurrying to trade. Goldman just fits what I like to trade really across the board. So that's I think what I'll do.
So now I'm looking at a little bit conversely. You were pointing out some of the strength. I'm seeing some of the laggards. I mean, look at Square. Square has almost double the downside of anyone else on the payments list.
Yes.
Square specific, and that's, I mean, they've got to get out of their Bitcoin crypto nightmare that they tried to rebrand themselves as basically a crypto company. Clearly, I mean, look at Coin yesterday. It's not working out well.
Right.
European banks, my goodness. I mean, my goodness. I know the UK just came out and said that they're expecting really rough times in terms of recessionary forces over the coming year. Right? They were predicting recession well into 23.
So that would be, I don't have any of the British banks, but let's see.
But Europe, I think, has pain to go through. This winter is going to be a rough time for Europe, given the energy crisis that they've got coming on, the conflict in Ukraine.
The question is whether or not that's already priced. And
Well,
is it going to be bad as realized is more the question I think that we're faced with now.
There's the economic problems, but I mean even the social turmoil that leads to further economic problems. People don't just stay cold all winter and let that happen passively. So we are getting a question here. Oh, all right, Eduardo. Eduardo, there's something we need to talk about. You called out Bumble, and now Tyler and I are very happy individuals.
Yeah, we both bought the 35 puts. So that's after a 6% day yesterday, even before earnings. Nice call.
So Eduardo, we owe you a drink, buddy, and an expensive one at that. So thank you, thank you for catching that. So this is going to be Foliko Live featuring Eduardo, but we do have a question from Eduardo today. He is saying the earnings power health score for HBAN looks similar or maybe better than GS. How do you interpret earnings power versus stock price forecast? So I'll go ahead and start pulling that up.
So my theory, and this is just my theory, is that earnings power is more important on earnings week and on earnings day. That's why I talk about looking for the divergence 2, 1, 2, or 5 days before, not 10, 20, or 50 days before. I want to see it on earnings week. So I basically think of our price forecast as the prevailing trend, else the earnings power health factor. So if let's see, you said HBAN, how far away are we from HBAN earnings? So HBAN earnings will be in 78 days. So in 72 days, I will say the health factor supersedes, the earnings health factor supersedes the price forecast. But to me, when I'm thinking about the prevailing breezes of our price forecast. It is specifically the price forecast. I more think of the earnings power as a catalyst on a catalyst day, if that makes sense.
Yeah, I mean, if we look at Goldman Sachs right here, we see earnings power going down sympathetically with stock price. Earnings power healed a little bit from July 6th up to 18th. I think GS had a pretty good earnings release. I wouldn't say that
Yes,
that earnings release was necessary. I mean, that degree of reaction was not necessarily caught in this earnings power, I would say, in this case. If we look at HBAN, they have just an awesomely rallying earnings power going this, but there's been a pretty sympathetic price movement alongside it. So I
and
wouldn't necessarily say that we have a mean reversion opportunity there.
that's ultimately my question: is how much of the recession is priced in? Where is it priced into? Is really the question, because to me, I think of regional banks and the housing market as being decently linked. So, in a situation where regional bank prices are somewhat stable, the rest of that market, soup to nuts, from the actual buying of the home to the origination to the securitization, if that whole pipeline is flowing, I don't know how much trouble the economy really can be in. Of course, there's things have gotten tighter on the consumer. We have seen signs of them starting to lever up, things like that, but not like, oh, the whole financial system is giving way underneath us, like 2008, for example. So that's interesting, because we like when our data agrees. It gives us more conviction. So we really like to see the banks bottoming, kind of in the similar context as tech, because now we can really start to build and look for what else supports this idea of late September kind of bottom. I think we have October 2nd as like the literal, dead nuts bottom. But I think, if we manage to get that within 2 weeks, I will call that a win.
Which is again something that we're constantly reanalyzing. I mean, this is something that's heavy on our minds. We're making models right now specifically for market conditions. So we have models that are strung on tickers, and what we do to inform our market views is we aggregate. Here's what all the tickers are doing. Now we're going to be making and producing models specifically for a market view, and so that's going to be coming out in the next few weeks, and we'll be able to give a better interesting view on that. The nice thing about that model is that not only are we going to be able to say overarching trends like we have been with, say, FANG and things like that, but day to day, week by week, things like that. So this is a good market week. This is a bad market week. You want to be on the short side. You want to be on the long side. That's the kind of view that's going to be giving you. So I'm excited for that. Banking in a recession time, I'm sure it's been priced in the threat of a recession to these banks.
I mean, the yield curve's well inverted, and that puts significant pressure on banks to explain in the too long didn't read fashion. Banks borrow on the short end of the curve, lend on the long end of the curve. The higher the spread that is, the better business is. There's a lot of other things that go into it, but in one sentence, that's why the yield curve matters for banks.
So does that mean that banks are underpriced right now if we're not going to really have a severe recession? I mean, the way it's looking is we will realize that we're in a recession right as we're coming in out of it. Like
100%. That's always how it works. And it's really an interest rate question. It's all an interest rate question, because we have a weird juxtaposition of rates where traditionally bonds acted as the safety valve. So if equities took a hit, bond prices went higher. But because of this inflation dynamic, that hadn't necessarily been the case. We're starting to see that channel kind of return again. Bonds have gotten ridiculously cheap against stocks, so I think some of that is just kind of a asset class repricing against the other. But ultimately, it's an interest rate question, in terms of what's been priced in terms of a recession. The Eurodollar curve for next year, as we discussed, March through December, would tell you that we're pricing being on the other side of the recession, fighting the recession and being on the other side pretty soon. So that's the whole question. that's your bank long, that's your curve flattener, steepener. It's the entire market's pretty much one trade. Short the dollar, is long stocks, is long, like it's all one trade pretty much, and that's we're doing the best we can to solve for what else is moving price other than general market data, and that's why I've actually been pretty encouraged with how we've done, especially because we've had a week where the market just went completely against all of our calls and we basically lost due to beta more than our calls. So it's all one trade, and that's really the question in terms of when our bank's bottoming is how do you think about the juxtaposition of the Fed, inflation, and financial conditions and risk, I guess.
Fair enough. So 4 weeks, we have banks hurting for the next 4 weeks. That's what our models are telling us. What do we want to look for to validate or contradict that hypothesis?
It'll depend on. So first we'll have a Fed meeting in September. We'll see 50-75 there. Just more. I think you need to see more cards is really the problem. If we were playing poker, you probably you want to see the turn here. I think if you can stay in the hand, because I as we were talking about before the market, thank goodness that we have a data driven process, because this is as confused as I've been, because to me it's very clear the Fed won't be cutting next year, but to the market it's very clear that they will be. And I think we just need some more information, really, and that's kind of why we've toned back our calls and our bearishness. Is the conviction is just less here, and I hate saying that. I want to have conviction 10 trades all the time, but sometimes knowing when you don't have as big of an edge is just as important as knowing when to really put your foot on the gas when you do. So I'm telling you, I keep talking to you about names that I like to short here in the third leg of a bear market that aren't growthy. ABBV, I'm looking at you. Healthcare, looking at you again. I know this is going to get old like semis did, but things like that haven't taken any adversity yet. I kind of think you should focus more there. But aside from that, you can wait. There's nothing, unless you are really looking at companies on a long-term basis and you think that if you buy them on a 3 to 5 year basis, you can see 100 to 200% upside, and you can start accumulating those companies. But for everybody else, you really can wait.
Mm. Makes sense. So something we're going to be keeping an eye on. We do need to get going for today. So thank you, everyone, for joining us. This has been Foliko Live. If you have questions for us, please feel free to ask it in the comment section below, and we will address it either at our next live show, or if you want to talk to us live and get that conversation going, join us at 8:30 a.m. Eastern Time, and we'll be here to talk through the market and Foliko insights every day. Thank you, Tyler, and we'll see everyone tomorrow.
Thank you.